Hello, everyone. Hope you're good. Hope you're well. Our topic will be on macroeconomic policy, specifically on money and monetary policy. So let's go. Money. So, money is important for life and living. We all need money, right? I need money. You need money. We need it to pay for stuff, for goods and services, pay our bills, to invest. Well, before something can be called money, there are different properties or functions. So money usually has certain characteristics that it has. So the properties or the functions of money include a medium of exchange. So money has to be something various parties accept as payment. This is as opposed to a barter economy where the double coincidence of wants is needed. So think about what used to happen in a barter economy. In such situations, I would need someone to want what I have and who has something that I want. So if I was a farmer, for instance, let's be more specific, a sheep farmer, and I wanted to buy a tractor, I would need to find a company who sold tractors and wanted sheep. Now with money, I don't need to do that. All I need to do is sell my sheep and buy a tractor, right? So think about any country you're in. The currency is accepted, right? Your pound, your naira, your dollars, your yen, you name it. Um, Money also has to be a store of value, so users should be confident that others will accept it in the future as a means of payment. So I could go put my money in the bank, right? And I'm sure that in the future I could still use it to pay for goods and services. What happens if I'm a sheep farmer, for instance? Maybe next year people don't really want sheep, but the value of sheep could come down, or my sheep could get sick. I need to keep them fed. I need to keep them healthy. But with money, I don't need that. I could put it in a hole. I could put it under my mattress. I could put it in the bank because I'm sure in the future it'll still be used as a means of payment. Money is also a unit of account. So it's something we use as a measure of the value of things. So £1, £2, £10. So the more valuable something is, the more money it should cost. So if I'm buying a car and maybe one's what £30,000, the other one's what £10,000. The one is what 30 grand should be more valuable. Of course, this doesn't always happen, but this is what it is. And money encompasses a whole lot of things: paper money, coins, notes, investment bonds, promissory notes. But yeah, money has to fulfill all these functions. Now, why do people hold money? The reasons why people hold money, we call this in economics as the demand for money. Okay, so why do people demand money? Well, we have three main motives for holding money. The first one is a transaction motive. So people have to hold money for daily living, right? To pay your bills, to get on the bus, to buy a drink. All right. The second reason for holding money is just in case. So a precautionary motive, right? So there's this saying, you don't know if you're gonna run into an egg carrier. Okay, these folks that used to go around in the olden days and sell eggs off crates on their head. Okay, or maybe something would happen, right? Maybe you get into trouble, or something happens and you have to spend money, right? So this is the second reason why people hold money. The third reason why people hold money is a speculative motive. So we're holding this while waiting to invest in other assets. So maybe there'll be an opportunity, right? I might get to know about a business deal. I might spot an opportunity to invest in. I might find this entrepreneurial venture. So I'm speculating. Maybe I should just hold money. It's not exactly precautionary, but this is, I'm speculating. I need to invest and make more money. And this is determined by expectations. So if I think I'm going to run into situations like that, I would hold more money. Now, the total demand for money is called the liquidity preference. Okay, so the total reason why people hold money is called the liquidity preference. So the market for money depends on the demand and supply of money. And anywhere where we have demand and supply, there will be an equilibrium, like we have studied in previous lectures. In this case, interest is the price you pay when you save or borrow money. So if you save money, right, you get paid interest. If you borrow money, you have to pay interest, right? So that's the price you pay. And yeah, we will get to an equilibrium where the demand for money should be equal to the supply of money. Who supplies money, right? You might say it's the bank, the central bank. Here we have the Bank of England, or it could be the government. And who demands money? The people, right? You, me, everybody. So we will get to an equilibrium like we've always done. So like we said in the previous slide, the overall demand for money is made up of the three reasons why people hold money. So that's the transactions motive, the precautionary motive, and the speculative motives. Okay, so the total demand for money, we call this the liquidity preference schedule. Okay, and what does this mean? Well, we know transactions motive, so people hold money because they have transactions to do. That doesn't uh, is not affected by the interest rates. So with higher interest rates or lower interest rates, you still have to have your transactions. For precautionary motive as well, you know, you're just taking caution just in case things happen. That doesn't depend on the interest rate. So we have that vertical relationship for the transactions and precautionary motive if we relate that to interest rate and the quantity of money like we have over here. However, the speculative demand for money depends on the interest rate, right? Like we said, interest is the price you pay for saving or borrowing money, right? Which is speculative demand for money. People will not want to hold money when the interest rate is high. So think about it. If the interest rate is high, then I'm better off putting my money in the bank and earning some interest, right? Also, if the interest rate is high, people will not want to borrow money from the banks. When interest rates are low, like we have over here, okay, with lower interest rates, people will want to borrow more money. So the quantity of money being borrowed or being spent, the demand for money will be higher. But at higher interest rates, the demand for money is lower. So you have that relationship, that downward sloping curve for the speculative demand for money. And when we put all of this together, our money demand, which is called our liquidity preference, made up of our transactionary, precautionary, and speculative demand for money, we get this downward sloping curve, right? When we put the whole thing together. So you can see that at higher interest rates, people will not want to hold money. They want to put it in the bank. At lower interest rates, people want to hold more money will be demanded, more money will be borrowed, and more money will be spent. So we've talked about the demand for money. Now let's talk about the supply of money. Now the supply of money doesn't depend on the interest rate. So the supply of money is assumed to be price inelastic. Who supplies money? Well, it depends on the monetary authority in your country. It's usually a central bank. Here we have the Bank of England. It could be the central bank of whatever country you're in. It could be the Federal Reserve. So yeah, it could be the central bank of Nigeria, for instance. You know, each country has their own monetary authority. Now, the interest rate does not affect the money supply, right? So we supply a quantity of money regardless of what the interest rate is. So we have this vertical relationship. So we've talked about the demand for money, we've talked about the supply of money, and now we can get to equilibrium in the money market. So we know equilibrium is wherever quantity demanded is equal to quantity supplied. Well, equilibrium in the money market is brought about by changes in the interest rate. So if you increase the interest rate, the demand for money will drop, and vice versa, right? So interest rates are higher, people won't borrow money, people put their money in the bank, okay? When interest rates are lower, people will borrow more money, people spend more money, people don't want to put their money in banks. You know, when interest rates are lower as well, that helps entrepreneurship because people think, okay, instead of putting my money in the bank, why don't I get involved in this entrepreneurial venture where I can earn more money? So we have this relationship that we have over here in this graph over here, okay? And what kind of relationship is that? So you can see interest rates are higher. With higher interest rates, demand for money is lower. With lower interest rates, demand for money is higher, and we get there. How about our money supply? We just have that vertical relationship that we had in the last graph. And of course, right here where money supply is equal to money demand, we have equilibrium, okay? we have equilibrium in the money market. Okay. Now, what happens when the money supply is greater than the money demand? So all this area that we have here, well, we have excess supply of money, so the money supply is greater than the demand. However, when the demand is greater than the money supply, we have all this what we have over here, and then we have excess demand for money. So now that we've talked about money supply, money demand, we've got into the equilibrium. Now we can talk about what monetary policy is. Like we said, monetary policy is usually done by the monetary authority of your country. So monetary policy is the process by which the monetary authority of a country controls the supply of money, often targeting an inflation rate or interest rate to ensure price stability and general trust in the currency. All right, so you don't want a situation where your currency is worthless. Nobody wants your money. We've seen this happen in several countries. In our microeconomic classes, we saw it in Yugoslavia. We saw it in Weimar, Germany. We saw it in Zimbabwe. So what we're trying to see is we don't want a situation where inflation is too high and then the money becomes worthless. So what can we do? How can we normally affect monetary policy? Well, the methods can include requesting that banks keep higher reserves and lend less out at any stage. This prevents the money supply growing and creates scarcity for money. So the money is more valuable. Remember, when things are scarcer, they're more valuable, like diamonds. Also, we can engage in open market operations like the selling of bonds to reduce the money in the economy. So the government could sell bonds, and when the government sells bonds, this mops up money in the economy because people buy bonds. And when the government wants to increase money supply in the economy, the government buys its bonds back, or they pay back for their bonds. So they give out money and take back their bonds in pieces of paper. Now, the interest rate in the UK is determined by the Monetary Policy Committee, and we usually use this in the UK to achieve a fixed inflation target. So for instance, if inflation is too high, interest rates go up. So when interest rates go up, we said people want to hold less money. So interest rates go up. It means mortgages are more expensive. It means loans are more expensive, and people spend less. Of course, if we want to stimulate the economy, then we bring the interest rate down as well. So what happens if we have an increase in money supply? So we increase the money supply in the economy, what happens? Well, an increase in money supply is likely to lead to a lower interest rate. Now, why does this happen? So there's more money supply in the economy. Remember, when things are more valuable, then they're more expensive, right? So if there's an increase in money supply, it means money is less valuable, so banks don't have to charge higher interest rates, and they don't have to offer higher interest rates to get you to invest, right? Because there's a lot of money, right? So the interest rates will be lower, and of course this would lead to certain things. So lower interest rates are likely to lead to an increase in consumption. So when interest rates are lower, people will spend more money as opposed to putting them in the bank, and spending that money is an increase in consumption. Of course, part of that spending will also be in investment, so this will also increase investment. So people will open new ventures, new entrepreneurial ventures. They will do stuff that they've always wanted to do, build infrastructure, build houses, start new businesses. And of course, this would also reduce the exchange rate. So because our interest rates are lower, we can produce more. The value of our currency will drop because we're charging lower interest rates, and we can export more because the value of our currency is lower. So the value of our goods are also lower compared to goods abroad, and it'll be more attractive for people to buy our goods as opposed to goods from other countries. So that will also stimulate export demand. Now, all of this will boost aggregate demand, but the effect of this on prices will depend on the elasticity of aggregate supply, like we've done before. Okay, so that would all depend on the elasticity of aggregate supply. So yes, now let's talk about financial institutions within the UK. When we're talking about financial institutions within the UK, we obviously have to start with the number one financial institution in the UK, which is the Bank of England. Okay, where is it located? It's located in Threadneedle Street in London. It's a fantastic building, as you can see over here. It's really great, you know, really fancy. So what does it do? Well, the Bank of England was established in 1694. It's the UK central bank, and we'll talk about central banking in a minute. So what does this mean? It means it's the government bank. It's the government's bank. It handles all government transactions. It's also the banker to all the commercial banks. So all your commercial banks in the UK, you name them, you know, Lloyds, TSB, NatWest, RBS, HSBC, Nationwide, you name it. All our banks have to bank with the Bank of England. It also holds gold and other foreign exchange reserves, which is used to influence the foreign exchange rate. We'll talk about this more when we talk about the exchange rate in another lecture. Of course, the Bank of England also issues notes and coins. So all your pound notes or your pound coins, they're all issued by the Bank of England. And of course, it also promotes and maintains monetary and financial stability to contribute to a healthy economy. So the monetary policy we've talked about, the setting of interest rates, the open market operations, okay, all of this to ensure that our currency doesn't become worthless and to ensure financial stability, they're all handled by the Bank of England. All right, we can talk about more functions of the Bank of England. The first one, obviously, is that it's a lender of last resort. So if all the banks in the country run out of money for some reason, right? So if I become rich and I withdraw all the money from all the banks. So if all the banks run out of money, they can borrow from the Bank of England. Okay. Theoretically, that's possible. Has it ever happened? So if all the banks run out of money, they can borrow from the Bank of England. The Bank of England also sets the reserve ratio. So this is the minimum percentage of the deposits that banks are required to hold. It's 3%. It was 3% as of 2016. It might go to 4.95% in 2019. So it's the minimum percentage of the deposits the banks are required to hold. So if you put in £100 in your bank, for instance, now your bank must hold £3 of that money. They could lend the other £97 out, or they could do whatever they like with the rest of it, but they have to have £3 in your vault. The Bank of England also sets the base rate. So this is the rate at which the Bank of England will lend to other financial institutions, which will in turn influence the rate that other financial institutions will lend out. So think about it. If the Bank of England lends out to other institutions at say 10%, then other institutions won't be able to lend out below this rate, right? So they'll probably lend out above, say 11%, 12%, you know, 10.5, whatever, but not below this, because then that would be loss making for them, right? So yeah, these are the other functions of the Bank of England, and this would also relate to whatever country you're in. Normally central banks do this as well. They're usually the lender of last resort. They set the reserve ratio and they also set the base rate. All right, so let's talk about more functions of the Bank of England, this fantastic bank that we've been talking about. Like we said, it's a central bank. So let's talk about the Bank of England as it relates to central banking. Now, what is a central bank? A central bank is the public authority that provides banking services to governments and commercial banks, supervises and regulates financial institutions and markets, and conducts monetary policy. All right, so your central bank is essentially a bank that provides banking services to the government or whatever country you are in. Also, it provides services to other commercial banks in your country. It supervises and regulates all the financial institutions in the country and the markets, and it also controls and conducts monetary policy, like we've discussed. A central bank provides banking services to the government and the commercial banks, similar to those that the commercial banks provides to individuals and firms. So remember, when you go to your local bank, all the services your bank offers to you, well, the central bank offers all those services to other commercial banks in the country. A central bank also provides monetary policy services to the government. So monetary policy is the attempt to control inflation and moderate the business circle and provide the foundation for sustained economic growth by influencing the quantity of money, interest rates, and the exchange rate. So the central bank controls monetary policy by supervising things like the interest rates, the exchange rate, the quantity of money, and all these things have the aim of sustaining economic growth and helping our economy to be strong and secure. So let's just have a quick run through of other financial institutions in the UK. We've talked about the Bank of England. Now let's talk about commercial banks. Commercial banks, some will call them retail banks. These were established under the 1979 and 1987 Banking Acts as consisting of a series of financial institutions supervised by the Bank of England. Some examples of these would be Barclays Bank, Lloyds Bank, NatWest. They provide banking services for individuals and businesses in the form of current accounts, savings accounts, loans, and all that. Next, we can talk about merchant banks. Merchant banks specialize in receiving large deposits from and lending to businesses. They also raise finance. Some examples of these will be Barron's Bank, Judge Peabody & Co., and AIB Capital. Next, we can talk about building societies. Building societies are owned by the people who save with them. For example, Nationwide, although recently some have become owned by shareholders in the 1990s, like Halifax or Abbey National. Next, we can talk about finance houses. These specialize in lending to individuals. For example, Finance House Limited, Self-Build Portal, Imperial Blue. Some of them specialize in lending to people who want to build their own houses, for instance, or need specialized loans for various reasons. Finally, we can talk about discount houses. So discount houses specialize in short-term lending to the government through the bank to local authorities. So they borrow money on short-term notice, then lend out. Examples would be Alexander's Discount PLC, Carter Allen Limited, Clive Discount Company Limited, and you can Google and find some more. All right, just to wrap things up, in closing, these are our class activities for the week. So what's your view of money? What do you think about money? We said money has three properties. It's a medium of exchange. It's a store of value. It's a unit of account. What do you think? Should we broaden our definition of money? So there's this thing about cryptocurrency, for instance, as opposed to paper money and all of that. So what's your view of money? Is money a good thing? Is it a bad thing? Some say money makes the world go round. Others say the love of money is the root of all evil. What do you think about money? And finally, what monetary policy should the UK pursue? All right, ladies and gentlemen, thank you very much. Hope you have a fantastic week. Bye.